This program was produced by and first broadcast on Radio Kidnappers, a volunteer-based community access station. For more information, go to www.radiokidnappers.org.nz. Thanks to New Zealand On Air for making this program available through funding the Access Internet Radio project.
You're listening to Radio Kidnappers, the voice of Hawke's Bay. This is a program called Real Wealth, and it's our pleasure, as always, to have in the studio Glenn Trillo from the Studio Group. How you going, Glenn?
Very well, thanks, Ken. Yourself?
Oh, can't complain. Can you believe it? We're now into autumn.
We are. Yes, March. Wasn't that long ago when we were celebrating Christmas.
I know. Where did that summer go?
It's gone, yes. A little bit cooler temperatures.
Darker in the morning when I come to work as well, and like you say, plenty of dew on the grass when you're cutting the lawn.
That's right.
Jeez, you know, summer's over when that happens.
Absolutely.
Anyway, today, Glenn from the Studio Group. Remind our listeners what the Studio Group actually does before we talk about today's topic.
Yeah, we're authorised financial advisors. We do goal-based financial planning for people. And we're situated at 204 Karamu Road in Hastings.
You are indeed, and if we want to come and see you, it's as simple as a phone call.
Absolutely, 0800 878 961.
Now we're talking about financial advisors that you are, but you deal with insurance, you deal with saving, you deal with Kiwi Saver. The whole thing.
The whole thing.
And you don't need to be a multimillionaire to come and see you guys. You can be Joe Blow off the street.
Absolutely.
Okay, and now today we're going to talk about unit trusts versus direct stocks. First of all, tell us what unit trusts and direct stocks are.
Yeah, so a unit trust, it's best described as a collective investment. So a unit trust works by pooling together funds from a number of investors, which is then used to purchase a variety of investments. So typically either shares or bonds, fixed interest.
Okay, so what's the benefit of having a unit trust?
The benefits, the first one is diversification. So when we look at a share portfolio, as an investor, you should have at least 20 to 30 different types of shares within your portfolio, and that's across at least 10 industries. And those numbers I've sort of provided to you are at the very light side, but that's the bare minimum. So as an investor, when you look at buying shares and you decide which one should go into your portfolio, there's some questions you should be asking, some due diligence everyone should be doing. What does a company do? Is the company profitable? What is the company's earnings history and outlook? How are the company's stock actually valued? Who are the company's competitors? Who runs the company? What does the balance sheet look like of the company? You know, their debt to asset ratio. And you should actually take the time to look at the company's annual report. Now, as I go through all those items, I'm aware that most investors either don't carry out their due diligence.
No, of course not.
Or just don't have the time.
We would expect you to do that for us, wouldn't we?
Absolutely.
Yeah.
And certainly, you know, we know that people often don't do that sort of homework that should be required. Okay. And the great thing about a unit trust is in the hands of professionals. Yeah. And those professionals are fund managers. So all those items I've just gone through, the fund manager has done the work for you. Yeah. Okay. So, you know, unit trust will have an investment strategy, whatever that may be. It may be a global type unit trust where they are looking at particular areas of the globe that they will invest your money into. Yep. And the job of a fund manager is to do all the due diligence to ensure that the unit trusts do actually follow the investment strategy. Okay, and you can be safe in the knowledge that your funds are going with a professionally, or with a professional in the form of fund manager.
I wonder if you just wind the tape back just a little bit.
Sure.
You mentioned at the start of your little talk there that you think it's a good idea to maybe have 20 to 30 differing shares across 10 industries. But I wonder if mum and dad investor come along and say, look, Glenn, I'd like to invest, 10 grand into shares because, I'm just looking forward to my retirement a little bit. Yeah. Haven't got a lot of money. What would you be recommending to someone like that? Would you be still recommending 30 different types of shares or?
Absolutely. Now, with that sort of dollar figure that you mentioned, it's very difficult for a DIY type investor to get diversification. To take $10,000 and to invest it across that number of companies, very difficult. Yeah. And that's where unit trusts really come into its own, because your $10,000 is pulled together in a much larger parcel of funds.
Yep.
You get the benefit. So, a share may be trading at $30 for a single share. Okay, so $10,000 won't go far.
No.
But with units, you're not actually buying individual shares, you're buying units.
Right,
So
becoming part of the whole.
becoming part of the whole. So, shares are purchased, but then they are what we call unitized. So the actual value of the units are lower than the value of the shares. So you end up buying a useful number of units with your $10,000, say. So certainly it covers those people with a smaller amount of money right up to those investors with a significant sum of money. So certainly those people with KiwiSavers, if you have KiwiSaver, you'll be invested in unit trusts.
Yeah, right. And of course, we can minimise the risk. We've talked in other programs that if I'm getting on a bit, okay, not long to go until I retire, hopefully, and I probably want to make sure that my money is in a low to medium risk rather than a high risk. And that's the same that could happen with unit trusts. You could say, okay, well, this is a low risk unit trust. Is that what happens?
Absolutely. So unit trust can also be defined as high risk, medium or low. And when we at Stewart Group put together a investment portfolio for a client, we will have a mixture typically of differing unit trusts. So if we look at a higher risk, they are typically shares or equities. And within that, for example, emerging market, that's quite a higher risk strategy in shares. But then to offset that, we will include some fixed interest or bonds unit trusts within the client's portfolio just to mitigate some of that higher risk assets.
Who decides what the best unit to go in is? So I come and see you, say, look, I've got my 10 grand here, I want to invest it. Do you say, well, you could go into this one or you can go into that one? Or would you say, just leave it to me and I'll give you the best deal going?
Yeah, that's a collaborative approach with the client.
Yeah.
So certainly we will do a risk profile with the client. So get them to ask some questions just to see what their appetite for risk is.
Yep.
And also to find out what are your goals and objectives. And really important, what is your investment time frame? You mentioned, as you were talking there, Ken, about a client that may be approaching retirement. Now, there's a bit of a misconception out there from a number of people we talk to. Just because you reach the age of 65 and you can get your money out from KiwiSaver, that's not to say that you should be taking it all out either.
Yeah.
You can imagine the average person may have another 20 years to go to live. Then that money should be lasting you for another 20 years, say. So that's all part of your investment time frame.
And we should still be investing into KiwiSaver, shouldn't we?
Absolutely.
Yeah, so even a minimum amount.
Yeah.
Okay, so you come along, you decide, okay, this is the best way for me to go. What about if I decide, in a year's time, I wouldn't mind getting my money out of it? Is it easy to get my money from a unit trust or?
It is. Unit trusts typically make it very easy to withdraw funds. Most unit trusts allow for withdrawals within 3 to 5 working days. Okay. And unlike if you own shares directly, you have to go to a share broker, have them sold, and there's a cost of doing that. Anything from 0.5% to 1% on the sale, and also on the purchase as well. So it can be quite an expensive exercise. With unit trusts, many of them are so large that they often have money being deposited into the trust every day. So if you came along and said, look, I wish to withdraw funds from it, 10,000, 15,000, whatever the case may be, it often means that the fund manager doesn't actually have to sell any units. They can simply give you the money and the cost of trading is so much lower. So that's another advantage.
Sounds too simple, Glenn.
It is simple. It really is.
No, I don't know whether you've experienced this, but in my experience with old people, they like to keep an eye on, what their money is doing. They want to, bring up the bank and say, hey, what's my account look like? Or I can get a statement which shows how much interest I've got going. Is that simple to do with unit trusts as well? Can I just go into the web and say, okay, this trust that I've got or this unit trust is performing like this today? Is that a good idea for me to do that as well or not?
Absolutely. To answer your question, it's very easy to do and it's a good idea to do. So you can go online. Certainly at Stewart Group, we give online portal access to all of our clients. Many unit trusts do actually appear in newspapers, sort of like a leaderboard, if you will, provides information. And it's done in such a way that if you have your own number of differing shares in your sort of DIY portfolio, trying to track each and every share and how it's been performing can be a lot of hard work. I've seen some people do it with varying degrees of success, but a unit trust is easy to track.
Yeah. As a punter, what would probably be the top 3 reasons that I might actually go for a unit trust as opposed to you advising me of some other sort of investment?
Yeah. Top 3 reasons: diversification. It allows you to have a truly diversified investment portfolio. Second one is your funds will be in the hands of a professional, a funds manager, and often will involve somebody such as ourselves, a authorised financial advisor. The third one, and this comes up quite a lot with people, is at the end of the financial year, you had to pay tax on your dividends received or distributions received. Trying to get all that information together for your accountant can be a nightmare if you have individually owned shares.
And you do all that for us?
It is all done for you, and unit trusts just make it so much simpler.
You're listening to Real Wealth on Radio Kidnappers with Glenn Trillo. We're going to take a break, have a song. When we come back, we're going to talk about the importance of rebalancing, and we don't mean your car wheels.
Absolutely. Not meaning car wheels.
You're back on Kidnappers, the voice of Hawke's Bay. This is Real Wealth. We have in the studio Glenn Trillo from the Stewart Group. Just to remind our listeners, Glenn, the Stewart Group, where are you?
We're at 204 Caramel Road in Hastings, and our phone number is 0800 878 961.
In the first part of the program, we talked about unit trusts as opposed to direct stocks. Did we cover why we wouldn't go to direct stocks?
Not particularly. Direct stocks can still have their place. Certainly, I guess for an investor who knows his subject matter, who has the time to do the due diligence on the company stocks or shares that they're purchasing. So it still has its place, but probably for the more knowledgeable investor.
Is this the guy who picks up the phone and says, buy this, sell that?
That type of person.
Yeah. Are there people like that around, really?
There are some people around like that who likes to think that they can do that, but my experience often shows something different.
Now, I want to talk about rebalancing. What's that?
Rebalancing a portfolio. So within a typical investment portfolio, if you go through an advisor such as Stewart Group, you will have X amount of percentage in shares, and that may be so much in the Australian market, so much in the New Zealand market, and so much globally. You'll also have a mixture of fixed interest, or what we call bonds, or many people call bonds. And that's also in New Zealand, Australia, and globally as well. Now, as time goes by on the investment portfolio, those weightings will come out of kilter because you'll find that something will overperform and then something will underperform. So it's really important that a portfolio is rebalanced at least every 6 months, if not more so, maybe quarterly. And the reason for that is it just ensures that the investment portfolio is not overly dependent on a particular success or failure of a particular asset.
What about low-key investors? I mean, someone like myself, I probably wouldn't want to be worried about it. I think I'd come to you and say, okay, Glenn, this is what I want to do with my money. This is how much I got. And then I probably wouldn't want to think too much more about it. But would you then, on my behalf, say every 6 months, come to me and say, hey, Ken, look, we need to look at what you're doing?
Yeah. A financial advisor will do this on your behalf. And you should just, as an investor, you would entrust your financial advisor to quite simply perform this task for you. I mean, we will send out a report as Stewart Group to our clients to state we have done the rebalance. This is what we have bought and sold. But really, there's not much input from the client.
Don't have to think about it even.
Don't have to think about it.
And what else does rebalancing do?
In some ways, it's slightly counterintuitive in the sense that you actually end up selling some of the best performers, so the cream of the top of those assets that are performing the best. You take that money and you actually invest in some of the assets that are not performing as well. And why would you do that? Why would you sell down some of the stocks that have been really overperforming? You do that because those funds that you realise and you purchase the stocks that are not performing well, you're buying more of that stock for your money because the pricing of that stock is lower because it's not performing as well. And we know over time, all units, all stocks will have their time in the sun.
Indeed.
And that's the time when you want to be buying them.
When do you decide to sell or buy? I mean, I know it's going to be pretty hard for you to answer maybe, but I guess there is a thought that if you've got a stock which was at one time selling for a good price, then all of a sudden it's half the price of what it was. Is it a bit silly to say, wow, let's go and buy a whole bunch of those because it's going to go back up again? Is that the way it works? Well, do people do that?
Yeah, some do, and this is within the industry. There's a bit of a debate, I guess. When is the best time to rebalance? So you can decide to rebalance purely on a time basis. So you set it up to rebalance every 3 months or every 6 months, whatever the market may be doing at the time. It takes away all the emotion out of it, and it simply happens because you have to ask yourself the question: can you truly pick and time the market?
Yeah.
Another school of thought is, I guess, the angle that you're coming from, and that is you actually time when is it best to rebalance. So you do try and put a bit of picking the timing of the market into it. We typically do a little bit of both. We also allow for raising funds and rebalancing for clients with regular withdrawals. So I think you need to have both hats on in that space. We typically do it from a timing perspective, so every 6 months we will rebalance a client's portfolio, but we also look at rebalancing with what is actually happening in the market at the moment.
Now, again, we've spoken about it before that a lot of older people might be reluctant to invest in a unit trust because at least if you put your money in the post office and you're getting 3%, you know you're going to get 3% regardless.
Yeah.
Once we put it into a unit trust, should we really forget about it for 2 or 3 or 4 or 5 years, because you've mentioned that you're going to have your ups, you're going to have your downs, and that's always going to be the way with things like trusts, isn't it?
It is. So if you're investing into unit trusts that invest into shares, you should have at least a 7-year time frame. If you're going into fixed interest, or what people know as bonds, then really you should be having a time frame of 3 to 5 years at least going into that. But with our unit trust, a typical investor will be invested in over 8,000 securities worldwide. So very well diversified. It's across 44 countries. And certainly over time, it should give you a better rate of return than putting your money in the bank. Interest rates are really low at the moment.
Sure.
Great if you have a mortgage, not so much if you've got money in the bank.
Yeah, dead right there. And just before we let you get back to work, Glenn, just remind our listeners once again, we need to get hold of the Stewart Group for any reason, for any financial advice. How do we do that? Where are you and what's your phone number?
Sure, so we're at 204 Caramel Road in Hastings. Our phone number is 0800 878 961.
Good on you, Glenn. As always, a pleasure. Look after yourself. We'll talk to you soon.